lots going on, and there's a lot of news that came out that was not economic related, Brian. We saw what happened, the tragic news out of New Orleans and again in Las Vegas. And so there's a lot of things that are going on that is moving the market, but most of it is really not economic, and that's why we want to look into next week. But before we do that, there's some things that we need to talk about. One of them is the House Speaker.
Yes, it is really fascinating seeing the drama taking place as far as electing a speaker. Do you remember back 2 years ago, as far as with Kevin McCarthy, when he was elected House Speaker? I think that took like 4 days, 15 votes.
And that's normal, right?
It is.
To have more than one vote.
Yep.
But it's one of these things that we want to put behind us. And, we talk about things that they can move the market and change sentiment. But I think the news from 30,000 feet that I'm interested in is really all of this liquidity that's coming into the market, because we see bond yields going up. And I think that is really important to see how the market reacts with that.
That's correct. And one of the things that has happened, some of the auctions, so when the U.S. Treasury, when they are trying to refinance the debt, issue more debt, they have these auctions. They have been pretty well bid, is the lingo that's used. So people are buying them up, but at these higher yields. So it has seemed like we have had these Treasury yields move higher, but as they inch higher, more and more investors are viewing them as at decent yields, although it used to be that foreign investors were one of the dominant forces in the market. So it was foreign investors and the Fed as far as buying Treasury securities. Domestic investors, institutional funds, mutual funds, and that have really stepped in to fill that void as foreign investors have kind of been pushed to the side or decided to step out of the Treasury market.
And higher yields, Brian, are competition for equities. And as you pointed out, people can get a higher yield and lock that in, and they go, well, for this rate, I may not want to take as much risk in the equities markets. And so that pushes things up. But the other thing that happens is when those yields go up, we see what happens with the U.S. dollar, and that's really important for international trade.
That's correct. One of the things that happened over the last few months especially is when the Fed decided to signal that they're going to cut the pace of the rate cuts, but yet the European Central Bank signaled that they're going full steam ahead with theirs. That difference in the yields, that change in expectation about what that path looks like, really helped strengthen the dollar. And the dollar has really moved higher. Another example of that would be, say, with the Chinese currency. Their currency has depreciated relative to the U.S. dollar by about 4.5% since the end of September. A lot of that can be explained by the yield difference that you get in the U.S. versus in China, growth differences, inflation differences. So these types of movements that we see in the Treasury market with the yields, changes in Fed expectations, they can affect currencies. And then if it affects currencies, that can obviously affect import prices, export competitiveness. So it's actually kind of incredible how all these things are really interconnected.
And because commodity prices are priced in dollars, that's affecting commodities as well. But the thing that I want to point out here is this is not a permanent activity. In other words, we have a debt ceiling coming up, and the Treasury has to spend maybe up to $700 billion from their general account. That's going to act like quantitative easing, and that could turn around both interest rates and the U.S. dollar.
It really could. Yeah, that's a great observation, because if we hit that debt ceiling, which according to Treasury Secretary Yellen could happen middle of January, maybe end of January, they really can't issue new debt or more debt. They can take different maneuvers. They call them extraordinary measures as far as some of the accounting things that they can do. But if they're not issuing new debt, the U.S. Treasury, they start spending down what they have put in their savings account. Basically, it's called the Treasury General Account. It's the checking account that they have with the Federal Reserve. And so if you don't have as much issuance of Treasury securities, but yet the Treasury has amassed over $750 billion in this account, they will spend that down over time. And it might be, according to kind of the flows, according to the year, that could be kind of front-loaded as far as January and February with a lot of expenditures. Then when tax season hits, right, they get some of those receipts. So then that kind of can replenish it a little bit. So we probably aren't going to get to a critical point with the debt ceiling until maybe August. But we are likely to feel it in the markets, especially with Treasury yields and the dollar, a lot sooner than that.
So let's take a supersonic trip around the world, talk about what's happening Let's start with what happened in Puerto Rico. Was without power for a significant amount of time.
Yeah, that was amazing to see right before New Year's that a cable failed. A single underground cable faulted and basically wiped out power for the entire island. And it highlights the need for an infrastructure investment in Puerto Rico, but I think it also highlights around the United States and the world in general the need for more infrastructure improvement.
No question about that. And let's keep moving. We talked about potential issues. The government shutdown might be one. The other would be the longshoreman strike that perhaps could happen later this month.
That's right. So if you remember back in October, a lot of businesses were accelerating orders into the ports because there was the possibility of that strike. It did last 3 days, the strike that took place as far as on the East Coast, but they came to a temporary truce where it was really only in place until January 16th. So they have this like January 15th deadline for the dock workers and employers to come together. They're still arguing about automation and the use of it on the port. So that's going to be hitting the headlines pretty soon.
And then lastly, China looks like they're continuing to have a slowdown in their economy, and there's a way to measure it called the PMI.
That's right. There's this Purchasing Manager Index, and it's published every single month, and it breaks down the economic activity into manufacturing and then non-manufacturing. Non-manufacturing is like, services, logistics, things like that. And their Purchasing Manager Index for the month of December, overall, it did improve, but manufacturing dipped. And it's the non-manufacturing that improved. A lot of the things that drove the improvement in non-manufacturing was like warehousing, U.S. businesses beginning to place orders, trying to get in front of any possible tariffs that could be implemented January 20th or after.